Anyway, Sri, why do you still think 3.5%?
You mentioned it, Joe, in your beginning. You talked about how you have a 9.1% inflation and the target is 2%. You're far, far away. And much higher inflation rate also means you're earning a very high negative real return on your 10-year investment. Then you have to ask the question, why did the bonds rally over the last week? Take a look at what happened after Jerome Powell finished talking. The rally gathered steam as his press conference was ending. And what he said was he was talking about a slowing of the economy. He was talking about the fact that as they increase interest rates, the rate of change of his hikes is going to slow down. And this man is no Paul Volcker. He did not have to say that now. He was supposed to be saying that inflation was a paramount concern. Suddenly, it has switched over to growth and recession. So you referred to the Neil Kashkari interview on Face the Nation. You should look at it alongside a New York Times interview that he gave, in which he said he was surprised why the markets rallied in the last couple of days of the week. I can tell him why it rallied. It rallied because Powell gave every indication that he was going to back off. So if he is going to back off 75 basis point increases in the future, you may have a rally for some point in time, continuing. But as inflation stays very high, as you have the continuing issues with natural gas, oil, food prices, rent, you're going to see the 10-year yield rise again. That, clearly, Joe, is why I'm sticking with my 350 on the 10-year.
Totally based on how sticky the inflation situation is. And I don't know if we know, Sri. I don't.
Yeah.
Go ahead.
But what we know, it may not be 9.1, Joe. It may be 8.7. But you're not going to say hallelujah because it came down by 0.4%. It is still way too high. Unless you get anywhere near about 3 to 4% and seems to be suggesting it's going to 2%, that's when I would change again. Remember, I changed my expectation on bond yield in early 2021. There was a reason for that. Today, there is no reason to change my forecast.
Yeah, that's the old saying, why do you change? Because the facts change. But in the past, you've had calls that go totally against the grain for where you remember when you said we were going to stay below 2 for a long time, and we did. But did this surprise you that we went from, we were on our way to your 3.5, and now look at it, it's 265. What do you attribute that to, Sri? Exactly, the perception of a global slowdown, what's happening in China with the lockdowns, just a combination of all these things, because that's been a pretty quick drop back to 265 that not many people would have predicted, including you.
Yeah, you're right. I did not expect it in the short term either, but I did not expect the movement to 350 to be smooth. But I did not expect this big a drop. And I'll tell you
why is it here? What caused this?
Why is it here?
What's behind it?
One reason, of course, I talked about the Powell press conference. The second one, people talk in terms of recession coming. Recession is seen to cut total demand. Therefore, inflation comes down and brings down the bond yield along with it. That's the reasoning with the 10-year coming down. Notice that we are not in a recession. We are in a stagflation, which we have not had since the late 70s. In that case, bonds are also losers because you have a recession combined with high inflation because of the fact a few items refuse to come down in price, namely oil, natural gas, food, rent. So when you have a combination of recession and inflation, bond yields rise, they don't come down.